now midway through the trading year. So how are investors adjusting their portfolios for the third quarter and beyond? I'm joined by Barry McInerney, co-CEO at BMO Global Asset Management. Nice to see you here in New York.
Thank you. Nice to be here.
We have a lot of clients who've grown your assets under management quite a bit over the past 12 months. What are you hearing from them these days? Do they want to take risk off the table or put more risk on?
Well, I think there's concerns from our clients on both where the equity markets are now in terms of perhaps an overvaluation and the bond market with rising or interest rates soon rising. So there's concern, but we're still seeing a well-diversified portfolio, a slight overweight still to equities. We were overweight to U.S. equities last year. We've pulled that back a bit to more of an emphasis on international, particularly European and Asian. And the fixed income market, we're ensuring that the interest rate risk is defensible and more focus on the credit play. So overall, a diversified portfolio. Expectations are more modest, but also introduction of some other strategies to offer some diversification, including some alternative investments.
So what types of alternatives right now are in favor with clients? Because alternatives is a big, broad spectrum of different types of investments.
It is, and the larger investors, more institutional and high net worth, they have a very long-term exposure to real estate and private equity infrastructure. But the low end of the investor and the retail investor are getting exposure to alternatives through liquid alternatives, mutual funds. And so we've launched a couple ourselves where, again, very diversified with many separate single hedge fund strategies packaged into one portfolio that gives you a good return potential, but is really not very correlated with equities and fixed income, so the risk diversification comes through very strongly.
Is that where the growth of your investment products will lie for the rest of this year?
It's been really across the board. We take a very global perspective, so independent of where our clients are, and we have clients in 5 continents, we do always encourage global diversification, so we're seeing a lot more movement towards global from regional. And we'll see between equity and fixed income, but probably those two engines will continue to be used, but again, probably alternatives and other uncorrelated investment instruments will start to be more pronounced in a portfolio. So yes, I would see that could be a growth area. So
it sounds like you think the stock market gains might be a little bit muted for the rest of this year. Are stock markets overvalued in the U.S. in your view?
Well, it's getting late in the game, and there's selective opportunities, so you have to really deploy some very effective active management to evaluate those stocks that do have some opportunities. But really, it's all about corporate earnings going forward. The market can continue to give some returns, more modest returns in the U.S., if we continue to have strong corporate earnings. More top-line revenue growth, though, as opposed to just cost-cutting. So top-line, strong corporate earnings could still fuel it, but we're getting late in the game, and therefore, again, we've been having a more global view in terms of U.S. still having a good anchor in your portfolio, but increase your global exposure.
Are there any sectors that are undervalued, or sectors that might do better as interest rates rise?
Well, I think as opposed to sectors, we're seeing more interest in higher yielding stocks. So obviously a great search for yield globally as interest rates are so low. So higher yielding stocks are more of an interest we find. We also are seeing interest in low volatility equity strategies, which we deploy quantitatively, which puts those stocks that have less risk characteristics in a portfolio to give more downside protection.
Very interested to hear what you're telling clients on the credit side. For the clients that want to be in fixed income, for the first time in a long time, the picture might actually be changing in the back half of this year. So how should investors view their fixed income portfolios now?
Yeah, the way we've been advising our clients in constructing portfolios is to be rather defensive. Interest rates are rising and they will rise. We know that's going to happen. So obviously we took a barbell approach last year in terms of we think rates will rise more in the middle of the curve, so be more short and long, good opportunities there. But a less and less focus on interest rate anticipation and more on credit exposure. Reduce exposure to sovereign bonds. High yield, high quality high yield can give you some nice yielding returns as well. So it's been more of a credit focus for us, bottom-up credit focus versus interest rates. So.
Barry McInerney, great to talk to you.
Thank you very much.
Good to have you. I'm Rhonda Schaffler for The Street.